Hey, how's it going? This is Murray Bollier, and I'm super passionate to share this short video that I'm recording. I've been sharing these concepts for a while now, and by popular demand, I've been asked to get a shorter version of this. We have, as a society, we are so conditioned to think of rate and payment, rate and payment, rate and payment when it comes to debt and interest rates that we overlook what something really costs us when we borrow money. So I want to highlight three different concepts here in this short video that's going to be a significant eye-opener to you. It's going to allow you to make better financial decisions. Get off the rate and payment and start understanding the real math behind what you're paying. So concept number one is, first of all, I'm going to get me out of here. What are you really paying on a mortgage? I've had guys say to me, geez, I just got a 3% mortgage. That's like free money. No, it's not. All right, we're going to use an example of a $370,000 mortgage at 3% for 30 years. This is the payment you're going to make every month. And look at the interest you're paying right out of the gate, $925 of interest on the first payment of the first $1,500 goes to interest. Does that look anything close to 3%? The answer is, of course, not. This is actually 60% of the first payment is pure interest, pure bank profit. None of that is going toward the balance of your debt. That is money that is lost forever. That's your money that's lost forever. And so, if you look at the first 6 months, it's actually 59%. It's nowhere close to the 3%. How is that done? Well, banks have come up with this formula called closed-end amortized loans. And the way the schedule works is that you're paying a heavy amount of interest up front because banks know on average, the average mortgage is less than 7 years, which people either refinance or move. So they created this math so that you're paying a lot of interest up front. And if you refinance, you're starting that clock all over again. So you need to know that. That's point number one in this video. I'm going to make two more key points here. Point number two, I want you to know this. Every type of debt has interest rates and terms. However, the math behind how much interest you actually pay differs from every type of debt. Mortgage interest is different than credit card interest, which is different than lines of credit interest, which is different than student debt interest, which is different than personal loan, car loan. The math is different on all those. So you can't compare a 3% mortgage with a 3% car loan. It's completely apples and oranges. And they don't make it easy to understand, okay? Debt does not come with a manual. So know that. Forget about rate and payment. Understand what you're really paying. That's point number two. Point number three, we're going to leverage those two concepts to show you how to pay off your mortgage faster and potentially save hundreds of thousands of dollars of interest. How are you going to do that? Well, let me ask this rhetorical question. Is it smart to ever take out a 10% loan to pay off a 3% debt? Now, most people are going to say you're nuts. Of course not. But the real answer is it depends on the kind of loan that you use to get that 10% rate. As I just mentioned, the math is different on every type of loan, every type of debt. So as long as you understand the type of debt, you can make a better decision. You can't go strictly comparing interest rates. So for this example, this is just a tip of the iceberg. We're going to use a line of credit. Why? Because the line of credit uses simple interest based on an average daily balance, which is much more favorable to the consumer. All right. So we're going to borrow $31.99 at 10% on a line of credit, which is going to cost us $320 of annual interest. And if you divide that by 12, $26 of interest a month. Why are we going to borrow $31.99? Well, because of the nature of a mortgage, the interest and principal amount on each payment is linked for that payment. So the first month we have that mortgage, we're going to pay the $1,560 payment for September. Then we're going to also, in the same month of September, we're going to say to the mortgage bank, please apply this $31.99 that I'm borrowing. They don't really need to know that you're borrowing it. Please apply this $31.99 to principal. So the $31.99 is the next 5 months of principal added up. And so by doing that, by paying this off early, we're going to cancel out that interest, that interest, that interest, that interest, and that interest, totaling $4,600 of interest calculation. And the cost to us is going to be $26 of interest. Why? Because of the difference in the way interest is calculated. I would do this every day of the week, as long as this amount was less than that amount. If I'm saving money, I would keep doing it. This is something you can do on your own, but if you need help, we have a program, an award-winning program that will show you how to wipe out all your debt in as little as 1/3 to 1/2 the time using 35 pages of banking algorithms very similar to this. This is just one tip of the iceberg. It will do all this in the background for you so you can wipe out your debt on the path to financial freedom and do the things you want to do with the money and not pay a bank. So I hope that's of value to you. Please get a hold of me if you want to talk about this. And thank you for watching. I look forward to talking to you soon.